Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming in YouTube. We're going to take a look at the gold market, the silver market on the daily signals as well as the weekly signals here and see what the variable changing price momentum indicator is telling us for the coming week. Welcome again. We're trading last in gold at 1781, 1780, 70 up about $283. And we activated actually a buy trigger from the buy one level that you see here at 1773 early this morning. And we now just completed a target of 1782 from that level of 1773. At about 6:45 p.m. on the 27th, the market tested the daily buy one level of 1773, as you can see, and it reverted from there. This bearish price momentum, with the market coming down below the averages daily and weekly, activated a target of 1773, which was completed. And at about 7:15 p.m., it activated a buy trigger at 74.10. And the target was basically, again, the average above. And that was completed by 10 p.m. We gravitated and traded right around the average price daily and weekly, and came down about 1 o'clock a.m. in a very, very thin market condition, which is really when these attacks occur. It seems when the markets are closed, or it is not that liquid. So what you see here is, first of all, what the AI recommends when the price is trading around the average, which tells you basically it's neutral. And as a self-directed individual, you want to just wait until the market comes down to the highest probabilities, which is either at the extreme above or below the market. But those subscribers that are just joining me at this point, what pretty much I'm doing is I'm showing you how I trade the reversion to the mean. And I apply the VCPMI, which stands for the variable changing price momentum indicator, that identifies the extreme levels of the supply and demand above or below the market, where the reversion to the mean principle can occur. And so the algorithm mathematically uses a structure which is a perfect Fibonacci structure of 5 pivot points, 5 levels. Furthermore, the AI activates the pivot points into a mathematical probability factor that, for example, again, the average price is in green. And once we can extrapolate the average price, then we can pretty much calculate, the extreme levels above or below that average price. And in this case, the extreme below the daily average price is 1773 to 1765. The AI identifies, or the algorithm identifies 2 levels above and 2 levels below that average price. And then it tells you mathematically when and what is the highest probability mathematically that we can see the market revert. And the AI tells you the trigger point is when it touches it, confirms the price, tests that level, and reverts back up. And as you can see here, that's exactly what it did. Automatically, when it reverts and activates a buy trigger or a signal, the targets are already in place. Automatically, the level above or below are your targets, your nearest targets. Depending upon the multiples, that you can use either the daily or the weekly data to calculate your targets. And it tells you pretty much, just like a GPS, which is the way that I use this analogy to trade this trading tool, basically that when you decide that you want to come and trade, okay, you have no position, you take a look at the market on a day trade basis, and you can see right now the price is trading around the average. And if we calculate, for example, and we see that the daily average is 1782, the extreme above that daily sell 1 is 1791, the sell 2 is 1800. On the left of the chart, you see the extreme below the mean, which is 1773, which was activated early this morning, and also as low as 1765, which it tells you that potentially the market is basically very active, and the potential is still there for the day that price can potentially be the buy 2 level if gold decides that it wants to revert from here and it comes down below the buy 1 and all the way down to the extreme of 1765. Now, what I want to show you is that in using the weekly data, and I use this chart for the purposes of, for me, identifying that relationship basically between the daily and the weekly, which is really important for the algorithm to identify for you where the highest probability trades are, is pretty much to combine harmonically all the trends. And I watch all the trends, just to see the relationship of price to those trends. And depending on the alignment of those trends or the harmonic relationship of those trends, then I can see potentially whether the signal is a short-term, intermediate, and long-term. And when we do identify a harmonic alignment, like here, for example, between the daily 1782 and the weekly 1781, you can see that this area is very, very strong harmonically, and the momentum, if it does unfold and closes above 1782 using the 15-minute bar on the close of this bar above 1782, it's going to set up the bullish price trend momentum. And so, although it tells you do nothing, okay, just stay neutral, it identifies the climate of the market, more or less, bullish or bearish. And automatically, when it identifies that signal, it tells you the target's above 1791 to 1800. The next, as you can see, harmonic level that we're looking at is the 1797 to 1800. On the right of the chart, I have the weekly numbers that show the average weekly of 1781. And if the market, again, trading above 1782, has activated the weekly target of 1797. The sell to weekly target of 1812 is also being activated. So what we have here basically is the daily signal, excuse me, activating a buy trigger and the target is 1791. These are the targets that I recommend the traders in my private trading room to use for day trading targets. And I make a point of sharing this information way ahead of time, preparing my traders here for what's coming here. So that when it does happen, you know, that you don't question why or where is it going. Let me share with you this report that we published here pretty much in Seeking Alpha, mean reversion trading domain, or the marketplace area where pretty much I publish my information. And it is directed to the Associated Press as well. So feel free to check out my page on my profile in Seeking Alpha as well. This report was written over the weekend. It was published on the 27th at about 7:55 p.m. And it told you basically that the weekly trend momentum was 27.21 in silver, and it was bearish. And also, it gives you an additional filter in the report, basically, that is the 9-week moving average to identify basically the trend momentum. The weekly VCPMI is the moving average. In this case, 2609 is telling us that we're coming in with a bullish price momentum. And it also tells you pretty much where you may want to trail your position, your stop. Use the 2609 as your protective level initially, because if it reverts below 2609, then you're looking at 2580 to 2529 activated downside targets. But being that the market is on the bullish side, it tells you if long, take profits 2655 to 2689. These are the numbers that we're using today. So these are the filters basically in the algorithm that was written in C++ easy language. And what I'm doing here is I'm reverse engineering this intelligence to share here with you live with those that are serious traders or want to learn basically a way to trade the market successfully. I'm not making the claims that this is the only thing in the world, but it is one that I have found that consistently is successful in the results that I'm getting. And also for the benefit of my subscribers, basically, my traders that are following the methodology in a very disciplined basis. It gives you very specific guidelines for you to follow. And so here, basically, it tells you that the silver futures contract closed at 26.17. The market closed below the 9-week moving average filter of 27.21. Therefore, the trend is bearish. This is confirmation that the trend is bearish. But what you want to see here is that it also gives you the alternative that if the market comes back up above that, it would negate this bearishness. With the market closing above 2609, we're coming in with a bullish bias here this week. But it tells you as well, 2609 is your protective level. So what I've done is basically breaking it down for you, the easy language directions of the automated algorithm that is available in TradeStation and TradeStation platform. Feel free also to go to our TradeStation platform there and check out the automated algorithms. Coming back to what I'm teaching you here live, the same thing applies for the gold market. This report was published on 27th at 7:34, and the summary basically is the weekly trend momentum of 1838 is bullish. I'm sorry, this is bearish. I just caught a mistake there. At the weekly trend momentum by the market closing below, it's bearish. The VCPMI is bearish as well, coming into this week, but it tells you 1782, which is the weekly average. If a close above 1782 negates this bearishness, neutral. And so this information is truly a prospective way to trade the market. And so essentially what I'm doing here is I'm executing this exact strategy, and now you see it in the form of a chart that I use that shows you the same intelligence. And we validate it and confirm it by the TradeStation platform that you see here, basically, that is telling us pretty much the same thing. Let's watch the market here for a little bit, I think, as we in gold are beginning to get the market to trade above the 1782, that essentially will activate the bullish price momentum, and we could see the target of 1791 activated again. The silver market is showing a lot more strength in the gold market as it has activated a bullish price momentum, as you can see here. And so the target of 26.43 now is active if you're long. And what I mean by that now is expanding this, for example, beyond the day trade. As a day trade, the signal is neutral to bullish, and it tells you as a day trader, you want to wait until the highest probability, which is for the market to go up to 26.42, 43. Now, you know, as a trader, you say, well, if it's activating a buy trigger, how come I can't, you know, buy into it? Well, you can, and it's up to you to take the momentum signals according to your profile. What I'm showing you here is how I am managing this information to get 400% a year. And what I do is I take the path of least resistance. I wait till the highest probability to get long, as you can see here, but I do maintain a long-term core position that is using the weekly and the monthly and the annual signals in order for me to build an inventory without margin, without the risk of a margin call like the futures contract. And that basically is very individual. And so just to tell you how I'm taking advantage, for example, when the market, you know, like this, it's moving up and it's above the average price, I'm making money. My traders that are following this are making money without having to trade the market on day trading. I think it's very important to, as a trader, hold your impulses that tell you that you have to take the trade, that you have to trade all the time. And impulsive trading does not work or adhere to a disciplined system like following the artificial intelligence of an algorithm, for example, because it's a very systematic process. There's no emotion involved. There's no second guessing involved. And yes, you can execute it if you take it out of the context of the VCPMI. What it identifies for you is when the momentum breaks out. And if you're a momentum trader, this is a great tool to use the signals from the average price. And if you want to follow that momentum, you can. The only thing I can say to my traders, if you choose to do so, is that be careful because you're going to get chopped up. As you can see, the market will chop around the average price, sometimes a lot longer than you would like to. And unless you have the algorithm to guide you at the extreme levels above or below, you're going to be very confused and probably get stopped out constantly, which is the risk management suggestion that the AI makes. Basically is that it gives you three options for you to manage your risk than just a straight stop. In fact, it recommends don't use a straight stop. Use a straight stop only when you are making money, when the position is building equity for you to lock in, at worst case scenario, breaking even. And there's a lot of information to digest and absorb, you might say, in a trading session. And so, but if you would like to find out more about it, please reach out to me, to us. Go to my website, and you can request some information regarding pretty much being able to come to my trading room here. So since I'm on this subject here, let me show you how easy it is. All you need to do is just go to ema2trade.com and click on contact and just fill out a page, and you can ask me any questions or any specific market here, and I'll be more than glad to get back to you and respond to you. Coming back here to the markets, we're hovering around the average price on gold. And silver has activated a much more clear signal than the gold market here today. And the target, clearly once the signal is activated, is the target above of 26.43. So you can see the choppiness, the signal here from buy one, the target completed, and then it traded around the average, and it chopped around the average, and it's trading around the average. The highest, most optimal level is to allow for the market to go up to 26.43 or even into that 26.63 area, which integrates the weekly numbers and identifies this area as a high probability area, or what it calls is an area of distribution of supply. It tells you up here, mathematically speaking, there's a very high probability that if we see the price get up here, we can see supply come into the market or sellers come into the market. In the meantime, it's activated a bullish momentum, and so we clearly have the targets defined. We did recommend our traders to take this signal here this morning, and obviously 73 to 82, that's $1,000 in a session. That's not a bad day's work. Not a bad day's work. We bought gold, silver at 26.02, and automatically it gives you again the stop. 26.22 is the target and your stop. Very, very methodical trading. One of the things that I want to make a comment in terms of the fundamentals of the market here, that most of the fundamentals not changed, even prior to the announcement, or you might say the Fed's rhetoric on the meeting about the possibility of raising interest rates. And when you really think about the reaction of the market, it was pretty amazing to see that just the possibility of interest rates going up can cause this kind of volatility. So it's a sign of potentially the leverage that is in the market, which is at record levels. Everybody's leveraging the economy, the GDP. We got close to $30 trillion debt to deal with. And it's a precarious situation for the monetary system on a global basis, because it's never been in this situation where it's essentially has a ballooning debt, unlimited debt factor with negative interest rates continuing to pressure the cost factor, you might say, that would be astronomical in maintaining this debt. I don't think right now the market is capable of handling a rise in interest rates. You just saw the reaction of just simply talking about raising interest rates. You know, I've been doing this for some time, and what I see is always, I try to see anyway, is the market telling you what it wants to do. Pointing case, the gold market. Contrary to all this short squeeze, this fundamentals, this tremendously bullish picture, it's gone down from 2089 all the way down to 1700s in the last since August of last year. So the markets will do what they want to do, when they want to do it, regardless of the sentiment. The sentiment right now is being, you might say, moved to extremes rather quickly than before because of the internet. Information is traveling faster because of the internet and technology. And so, you know, it's a question of how you implement, you know, that intelligence. And as far as I know, the markets always are contrarian. Contrarian animals that will do the opposite of the fundamentals. Look at the stock market. On the face of a pandemic, as we saw last year, it has gone up to making record highs. And so I think what I'm saying to you is the fundamentals of the market do not work at this point in time. They are not working because they're lagging behind the market in terms of identifying the real fundamental damage that was done, to know exactly where we are. And we don't know. We're still, I believe, trying to stay above water and manage the crisis by crisis as they develop. And the, I believe, sentiment right now that we have is primarily focused on inflation. It's making inflation a major factor, excuse me. And although we are seeing the reaction of people coming back to the economy, this is identifying, obviously, supply chain problems, bottlenecks in the supply chain, and it's causing a tremendous amount of disparity, you might say, in pricing some of these things. And obviously, when you have the velocity of money chasing fewer goods, the prices are going to be reflected. Take a look at real estate. The one thing I can say to you as a trader, that the 10-year note, which is the indicator that I really watch, that tells me pretty much the what the market is saying. The bond market is not panicking on inflation fears. In fact, it's the other way around, that yields are coming down. And so, once again, what I'm trying to point out to you is the market knows something is happening here that is not inflationary, that more than likely, as I take a look at the possibilities, we're looking at rates reverting back down. 148 on the 10-year note. And the 10-year note is the major indicator for me in terms of the short-term volatility in the market, or at least the repo spreads, or the swaps, you might say, with regards to interest rates that may show where the pressure is on the spreads. And there's no pressure right now. Interest rates are not indicating that that we have inflationary pressures in the market. The other, in terms of the economic indicator, is lumber. It's pretty much collapsed around 790 or 750, I believe, the last time I saw it. It's up a little bit, but we saw a low of 763. And so what we're looking at is this the bottom of lumber? It definitely has collapsed, as you can see, giving up almost all the gains that it made since in March. So this is not inflationary, and therefore this translates into the cost factor built into construction, building homes, and hopefully we'll see a bit of a correction as well in real estate values. When the market is trading around the average, we pretty much stay pretty neutral. Continue to hold your coin position that we recommended long term. Now, if we take a look at some of these assets that we've been recommending here to hold on to, has been coin. Last week we purchased GBTC, which is the Grayscale Bitcoin Investment Trust. So stay long and have a great trading day. Have a great trading week in the meantime. And I will see you here in the trading room throughout the day. Have a great day.